Today we're diving into a critical question. Are we facing a housing market collapse?
That's right. With soaring HOA fees and rising inventory, the stakes are higher than ever.
And amidst these concerns, expert insights on investing during inflation are crucial.
Stay tuned because we'll provide in-depth summaries of today's top videos.
First, Reventure Consulting delves into the HOA crisis in Florida and its implications for the housing market. Next, Real Estate Mindset predicts an alarming housing market collapse driven by excess inventory. Then, Ken McElroy shares insights from over 10,000 tenants on economic trends and tenant behavior. Following that, Jason Walter analyzes the August 24 housing market update and what's ahead. BiggerPockets discusses lucrative opportunities in real estate investing for 2024. Later, Melody Wright uncovers systemic appraisal fraud in Texas and its financial impact. Ryan Scribner offers strategies to protect your money from inflation in 2024. Finally, Real Estate Mindset grapples with the rising trend of corporate bankruptcies and financial distress. Welcome to Reventure Consulting's channel on YouTube. Today, we're diving deep into the gigantic HOA crisis hitting Florida, where HOA fees are skyrocketing.
Indeed, this crisis is crucial for homeowners and may reshape real estate practices nationwide. With Nick Gurley at the helm, get ready for some eye-opening facts.
So, what's the emergency happening with HOAs?
The central issue is significant increases in HOA fees, some rising to $2,000 monthly, forcing many homeowners out of their properties.
First up, those HOA fees. What's the damage?
They're hitting staggering amounts, up to $2,000 a month in some places. Moreover, a poll revealed that 75% of you dislike HOAs.
Let's talk inventory in Florida. What's happening?
It's skyrocketing. With current homeowners forced to sell, the inventory levels are soaring, complicating the housing situation.
And how about the new Florida laws affecting condos?
A recent bill requires condo boards to be fully funded by 2025 for maintenance and repairs. This means hefty bills for residents.
What's the national picture here?
Nationwide, nearly 30 million housing units are in HOAs. That's about 25% of homes in America.
How's buyer demand looking?
Mortgage applications have plummeted by 50% from pre-pandemic levels. Even declining rates aren't bringing buyers back.
What do we expect moving forward?
If these HOA fees continue to escalate, we might witness a housing market collapse, particularly as inventory increases.
And how could perceptions change?
More buyers could turn away from HOA properties due to current management issues, creating substantial ramifications for builders.
So what's the takeaway?
Homeowners must stay informed and cautious, especially amid skyrocketing HOA fees. The real estate landscape is shifting. Are you ready?
Welcome back to Real Estate Mindset. Today, we're diving into the urgent state of the housing market and the impending collapse that's got everyone talking.
Yes, there's significant overcapacity in homes for sale, and the numbers don't lie. Buckle up as we unpack today's wild economic forecasts.
So what's the crux of today's discussion?
The core thesis suggests we're on the brink of a housing market collapse, with another potential 10% price drop looming, driven by an excess of homes for sale and economic uncertainties.
Let's tackle the first key point, the price decline. What are the figures telling us?
Home prices have plummeted by about 30% since 2005, and yet we might be staring down another 10% dip in the market soon.
Now let's talk about new listings. What's happening there?
New listings have indeed shot up by 5.9% year over year, likely due to rising defaults and sellers rushing to offload their properties.
And regarding days on market, what's the latest update?
Homes are now sitting on the market for an average of 34 days, indicating that buyer interest is waning, despite recent declines in mortgage rates.
Time for some predictions. What lies ahead for the housing market?
The forecast isn't rosy. We can expect a sharper market downturn and even greater price drops compared to the declines witnessed in 2022.
How about homeowner defaults? Any predictions there?
Yes, a significant increase in defaults among homeowners is anticipated, leading to a surge of inventory flooding the market.
To wrap it all up, what's the final takeaway?
In summary, the housing market is gearing up for a chaotic phase, and stakeholders must be proactive and strategic to navigate these challenges ahead.
Welcome to the Ken McElroy channel. Today, we're diving into fascinating insights gathered from over 10,000 tenants about what's really happening in the economy.
Absolutely. Shannon Wilcox, our Director of Property Operations, is here to share the real boots-on-the-ground intelligence. With her team managing nearly 300 people, she knows exactly what the tenants are feeling.
So, what's the main thesis we're investigating today?
The crux of the matter is straightforward. Tenants are returning to work, credit debt is rising, and savings have plummeted. This all indicates serious economic uncertainties ahead.
What have you noticed about work trends among tenants?
A significant number are heading back to offices, leaving behind remote work, which marks a big change from last year.
And what about their financial behaviors?
Right now, personal savings are at an alarming low, while credit card debt is surging. Tenants are financing necessities like groceries and rent.
Can you explain the Flex program that's gaining traction?
Sure, adoption is up by 12%. It helps tenants split their rent payments into manageable chunks, although it's still concerning they need such options.
What strategy should landlords focus on right now?
Occupancy is king. Keeping current tenants satisfied is more profitable than jacking up rent.
What should we brace for in the near future?
Unfortunately, as credit issues worsen, we may see a rise in evictions and homelessness, which is quite troubling.
Looking ahead, what predictions do the insights suggest?
The demand for rental properties will surge as many people shift from looking to buy a home to renting instead.
And economically speaking, what's the scoop?
Long-term, rental prices could rise again due to a shortage of new units hitting the market.
So, what's the big takeaway from these insights?
Landlords must adapt to the changing needs and conditions of tenants to maintain occupancy and navigate through these economic challenges.
Any final thoughts on tenant relationships?
Investing in tenant satisfaction and security today means a more stable and profitable rental future.
Welcome back. Today, we're diving into the latest housing market updates for August 2024, based on a brand new report from Realtor.com.
That's right, Jason Walter is our insightful guide, shedding light on the significant shifts happening in the real estate market this summer.
What's the crux of the analysis from Realtor.com?
The report indicates that the housing market is cooling down post-peak season, with inventory on the rise and a noticeable delay in sales, marking the slowest pace since 2020.
Let's break down those inventory levels.
Absolutely, we're seeing a remarkable 36.6% more homes for sale compared to last July, marking the highest inventory since 2020.
And how about the time it takes for homes to sell?
Currently, homes are averaging 50 days on the market, which is 5 days longer than last year. It's been a consistent trend for 4 months.
Now, let's talk about those price reductions.
Yes, the share of listings that saw price cuts rose to 18.9%, up from 15.5% last year. We're nearing levels last seen in 2022.
What's happening with pending home sales?
Pending sales have increased by 1.8%, indicating a steady demand, especially with anticipated rate cuts from the Fed.
Any regional insights we should note?
Definitely. Austin is seeing a whopping 39% increase in listings, while the South leads in overall inventory growth.
What predictions does Jason see moving forward?
If these inventory levels keep rising, we might see home prices stabilize and even correct in some markets.
And what about the Fed's influence?
Expected Fed rate cuts could trigger increased buying activity, making the market more competitive again.
To wrap things up, what should our viewers take away?
Jason highlights that while the housing market is cooling, upcoming Fed actions could shift dynamics, so staying informed is crucial.
Welcome to BiggerPockets, your go-to podcast for real estate investing insights. Today, we're diving deep into 2024's biggest opportunities to make cash flow in real estate, along with guest stars Ashley Kay and Henry Washington.
Ashley and Henry are seasoned pros in the real estate game. With years of experience under their belts, they've got the insights that can help listeners navigate today's complex market. Let's get straight to the facts.
What's the core theme we're tackling today regarding real estate?
The thesis here is that strategic flipping and cash flow investments are crucial in capitalizing on the ever-evolving real estate market in 2024.
What's the first key trend we should discuss?
Short-term rentals remain lucrative despite earlier uncertainties. Despite fluctuations, demand is high, making them a hot topic in real estate.
And what about flipping houses? What insights can Ashley and Henry share?
Flipping houses is garnering attention as experienced investors have found viable strategies that yield significant rewards. It's all about timing and market research.
Let's touch on financing strategies. How can investors leverage these?
Creative finance strategies such as seller financing can ease cash flow. Identifying under-rented properties allows for enhanced profitability.
Let's get into predictions. What do the experts foresee for the upcoming year?
Predictions indicate continued fluctuations in 2024. Rental markets will thrive, while flipping houses may navigate challenges.
What else can we expect?
Expect a shift toward creative finance as investors adapt to market demands in adapting to new challenges in real estate.
Before we wrap things up, any final thoughts?
In conclusion, the key takeaway is that flexibility and strategic leveraging of market opportunities will be crucial for investors to thrive in 2024.
Welcome back to The Forgotten American. Today we dive into a pressing issue: systemic appraisal fraud in Texas.
Absolutely. Joining us is Mitch Fexler, a seasoned real estate expert with 4 decades of experience. He's here to share insights on inflated home values and their impact on hardworking Texans.
What's the crux of Mitch's findings? What alarming practices are taking place?
Mitch's thesis underscores that the appraisal district is engaged in manipulation, leading to inflated property values. This not only squeezes taxpayers, but also threatens their financial stability.
Let's highlight those crucial points. Start with the CAD's admission. What's the bottom line here?
Well, Denton CAD's admission of manipulating 60,000 records led to a staggering 76% corrupt data margin. That's not just a statistic. It's a financial disaster for homeowners.
Now, let's talk about the financial repercussions for usual folks.
The average home value is over 40% inflated, and staggering data reveals that 37% of households could face bankruptcy.
And who's responsible for this mess?
Senator Betancourt, as a real estate tax consultant, plays a role in perpetuating this system. Clear call for revamped and transparent appraisal processes is needed.
What predictions does Mitch foresee?
Mitch predicts an economic collapse due to inflated values and mismanagement. Homeowners are on the brink of being overwhelmed.
And on a positive note,
with increased awareness, there's potential for grassroots movements to pressure local authorities for change.
So, what's the takeaway for our viewers?
The fight against systemic appraisal fraud demands transparency and accountability from local governments. Collective community action is crucial to restore fairness.
How can individuals get involved?
Individuals can sign the petition aimed at holding the CAD accountable. It only takes 10 seconds to potentially change the future.
Welcome to Ryan Scribner's YouTube channel. Today, we are diving into an ever-important topic: how to protect your money from inflation in the year 2024. Inflation's been packing quite a punch recently.
Absolutely. Ryan breaks down the critical relationship between inflation and our finances. His expertise in personal finance makes him the perfect guide through these turbulent waters.
So what's the heart of Ryan's message? How can we keep our finances afloat?
The core thesis is clear. Inflation isn't just a number, it directly impacts your purchasing power. Ryan emphasizes how savvy savings strategies can protect your money against surging prices.
Let's get into the nitty-gritty. What are the starting stats Ryan shared?
Since February 2020, inflation has surged a staggering 20.8%. But thankfully, as of June 2024, we've seen it down to a more manageable 3%.
What about the savings accounts? How should we be stashing our cash?
Great question. Ryan highlights that a high-yield savings account, like the one from UFB Direct, offers up to 5.15% APY, while traditional accounts barely break 0.6%.
How do interest rates play into all of this?
Ryan likens interest rates to a car's pedals. The Fed raises rates to break inflation by discouraging borrowing and spending, while lowering rates would encourage just the opposite.
Taking a peek into the future, what does Ryan foresee?
He predicts inflation rates stabilizing around a target of 2% in the coming years, with high interest rates sticking around for some time, which could benefit savers.
To wrap things up, What are the main takeaways?
Ryan stresses the importance of utilizing high-yield savings accounts as a robust tool to safeguard your finances against inflation, effectively keeping that purchasing power intact.
Welcome to Real Estate Mindset, where the tides of the economy flow in unpredictable ways. Today, let's tackle the urgent question: are we really broke? Join Eric Nelson, our economic guru, as we navigate these treacherous waters.
That's right. We're diving into the alarming trends showing rampant corporate bankruptcies and consumer struggles. Spoiler alert, the data tells a worrying story that might just knock the wind out of your sails.
So what's the crux of today's discussion? Are we calling for a lifeboat yet?
Absolutely. The core thesis is that rising corporate bankruptcies and diminishing consumer purchasing power signal severe economic distress, suggesting we may already be in a recession. It's like the economy is playing a game of Jenga. One wrong move and it all comes crashing down.
Let's break down those key insights. How many companies are we talking about?
As of June 2024, there have already been 346 bankruptcies in the U.S., marking the highest rate since 2010. Just imagine that. They're dropping like flies.
And what about the consumers? Are they holding up?
Not so well. Consumer debt is close to $18 trillion. Serious delinquency rates for credit cards are rising, showcasing that consumers are drowning in debt. They're like fish out of water.
What's happening with consumer behavior?
There's a significant shift, with consumer discretionary spending plummeting. Companies that relied heavily on consumer spending are paying the price, shutting down stores and filing for bankruptcy.
What's inflation's role in all of this?
Inflation is wreaking havoc. It's diminishing purchasing power, and credit tightening means consumers are finding it harder to secure loans. It's a double whammy.
Let's pull out our crystal ball. What predictions can we make?
The foreseeable future points to a likely recession. Expect corporate bankruptcies and personal delinquencies to increase significantly. The signs are all there.
Is the government stepping up then?
There might be talk of an emergency rescue plan. However, if history teaches us anything, it's that these plans often fail to tackle the eat away at the core issues, like economic fraud.
So what's the overall takeaway here?
Consumers must be aware of their spending habits because with the economy on shaky ground, every choice counts. Stay informed and navigate wisely out there.
Any final thoughts on actions that need to be taken?
We need immediate action. Addressing the looming bankruptcy crisis and consumer debt must be a priority before it spirals out of control. That's the scoop.
In conclusion, Reventure's Nick Gurley warns us about escalating HOA fees that could signal trouble for the housing market.
Meanwhile, Eric Nelson from Real Estate Mindset provides insights on the potential for a housing collapse due to increased inventory.
Both experts emphasize caution as the market shifts, aligning with Ken McElroy's insights on tenant behavior, indicating financial strain.
As we wrap up, remember that adapting strategies is vital. Keep an eye on your investments as we transition into an uncertain future.
Thanks for watching Financial Insights in Minutes for August 9th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.